Hi everyone, welcome back to the US CPA classes for business analysis and review. In this particular video, I'll be walking you through in detail about prospective analysis, including the use of data, and more specifically, we'll be covering capital structure and the leverage in the capital structure. So let's understand the concept of leverage in capital structure more in detail. Hi everyone, welcome after the break. So we are in the second chapter, topic 2.2.2, capital structure. So before we went on a break, we discussed about capital structure, overall, like what all things comes under the capital structure. Then we discuss in detail about risk, all category of risk, which include interest rate risk, reinvestment risk, liquidity risk, market risk, company risk, and credit risk. So now we will be starting the leverage. Like in leverage, we'll be understanding in detail about operating leverage and financial leverage both. And then if time permit, we'll jump onto the third topic as well, which is capital structure, including weighted average cost of capital. And then financial structure, we'll be able to do it tomorrow, right? So if you go back, like these all things we have covered so far, and then I think we did, okay, yeah. So we have covered till this risk. Okay, now jumping on to the second topic, leverage. So leverage, like we were discussing earlier before we start or when we started this capital structure entire overview, there are two type of leverage, operating leverage and financial leverage. And when you combine operating leverage and financial leverage, it may result into a complete leverage or total leverage, right? So the operating leverage, like we were discussing earlier, and I have shared like in the Excel sheet also, it is on account of impact from the operation, whereas financial leverage may be on account of financial cost that will impact, right? Here we'll be understanding more in detail. We'll understanding the theory, we'll do some examples, we'll do some illustration, and then we have some practice question as well to do this, to understand this in detail. The first one is operating leverage. So operating leverage, it is based on the fixed cost of business operation. Fixed cost of business operation. Higher the fixed cost, greater the risk that the break-even point will not be reached in the given period of time, or if there is a drop in sale. So the risk is not achieving your break-even point in a timely manner, right? So break even point, what is break even point? If you remember from the last to last classes when we have studied about contribution margin as well as contribution margin ratio, contribution margin percentage, it is absolutely the same formula. Break even point is equal to fixed cost divided by contribution margin, right? How do you identify fixed cost? How do you identify fixed cost? The cost which are fixed in nature for your operational expenses is called fixed cost here, like your depreciation, maybe your electricity bill, maybe your rental
Right.
expenses, right? Those all things are being kind of fixed costs for the organization that may be required for their operation. And what is the contribution margin? Your sales minus variable cost, right? Sales minus variable cost.
Variable
And
cost.
what is variable cost? That include your cost of inventory or anything specific relating to the sales which go along with the sales. So when you are making any sales, if there is any commission you are paying on each unit of sale, so that also comes under the variable if that has nothing to do with the fixed component, right? So your sales minus variable cost will give you the contribution, and your fixed costs are those costs which you need to incur bare minimum to run and manage the entire operation, right? So the break even point is fixed cost divided by contribution margin, right? So here in this example, what is your contribution margin?
250.
250,000. right? Everyone comfortable? Let's assume, like the units. Let's assume they have 10,000 units sales and 10,000 units this, and this is also same. So then per unit sale is this divided by this, right? Right, we'll keep on explaining on this example. So you have total 10,000 units which you have sold, and cost of selling that, the sales price is $50 each, and the cost, or you can say variable cost, is $25. So your contribution margin is per unit is $25,
Yes,
right?
sir.
So operating leverage relates to the percentage change in EBITDA to the percentage change in revenue. So what is called operating leverage? It is percentage change in earning before interest and tax divided by percentage change in sales. So that means this is your, let's assume, year 1. Now let's assume in year 2 you have, let's say, $600,000, $280,000, and let's assume you have salary 55,000, 32,000, 23,000, right? And your financial cost is $60,000, right? So let's assume this is your year 2 numbers, right? What it says, operating leverage relates to percentage change in EBITDA to percentage change in revenue. That means degree of operating leverage is change in EBITDA. How much EBITDA has changed? This minus 150,000. So this is change, right? So this has changed, and so what they're saying, sorry, my bad. So degree of operating leverage is change in net operating income, that is EBITDA, divided by change in sale. So what will be the value here? A change in EBITDA is 60,000 divided by change in sale. How much is the change in sale? How much is the change in sale? 100,000. That means 60%, right?
Yes, sir.
That's how you need to calculate the degree of operating leverage. So degree of operating leverage is change in earning before interest and tax divided by change in sales period over period. Make sense, everyone?
Yes, sir.
Right? Okay. So now other method would be contribution margin divided by operating margin. Whereas contribution margin is sales minus variable cost, operating margin is contribution minus fixed cost. Right? What they are saying, other formula could be contribution margin divided by operating margin. So what is your contribution margin? What is your change in contribution? Divided by, I need to freeze this. So what they're saying is contribution margin divided by operating margin. So operating margin is here contribution minus fixed cost. So this is your fixed cost. It means EBITDA. So that is this divided by contribution. So this will be the formula. EBITDA divided by contribution margin. Right? So result will same in both the cases. So it depend on like what are the information provided to you in question. Accordingly, you will be applying the formula. Right? Greater the degree of operating leverage, the greater the change in operating income will be given in a particular change sale. That means if operating leverage is high, right? If operating leverage is increasing, that means your EBITDA will be increasing proportionate to your sales or proportionate to your contribution margin. So how it actually means, if I draw one more example here, what does it means? One second. So one second, let me freeze this one. Right, here you go. So what they are saying, let's look at the sentence again. Greater the degree of operating leverage, the greater the change in operating income will be given in a particular change in sales. That means if the operating leverage is increasing, that reflect the small change in sale may have major impact on EBITDA or correspondingly more impact on EBITDA. If everything will remain same, let's assume there is a change in sale from 5 lakh to 500,000 to $600,000, right? So before jumping into it, let's do like yeah. So it's let's assume the new units is 12,000. So that means your revenue will increase to 50 multiplied by 12,069 and your COGS will change to this, right? And your contribution will change to this, right? And your operating expense is this. What does it show? This divided by your contribution margin is 67%, right? So if you go back here in the Word file, what it says, greater the degree of operating leverage. That means earlier operating leverage was 60%, right? Now it has increased to 67%. Yes or no?
Yes, sir.
Right? Now it has increased to 67%. It says greater the degree of operating leverage, the greater the change in operating income. That means proportionately how much percentage will be increase in income will be higher than percentage increase in sales. So 600,000, or if I say is equal to 600,000 minus 500,000, which was your earlier sale, divided by 500,000. So your sale has increased by 20%, your COGS has increased by 20%, your contribution has increased by 20%, whereas your EBITDA, if you see, has increased by how much percent? Is equal to 200,000 minus 150,000 divided by 150,000. Whereas your EBITDA has increased by 33%. This is what it means. What they are saying, the greater the degree of operating leverage, the greater the change in operating income will be given in a particular change in sales. That means if sale is increasing by 20%, your EBITDA will be increasing by 33%. Make sense? Yes or no? Or you
Yes,
have any
sir.
doubt? Right? So if the degree of operating leverage is high, that means small change in sale will result into better impact or more impact on the earning before interest and tax. If the sale is decreasing, right, for example, instead of 400,000, it's, let's say they are doing 8,000, right? So correspondingly decrease is also more, right? Decrease in EBITDA is also 33%, right? Make sense? So this is what
Yes, sir.
reflect degree of operating leverage. If degree of operating leverage is higher, that result into higher earning before and tax impact on account of change in sale. If the sale is decreasing, the impact will be negative. If sale is increasing, the impact will be positive. But it will be much bigger proportionate, either in negative or in positive. Make sense?
Yes,
Clear,
sir.
everyone? Okay. So now coming to one more thing. A company with a high degree of operating leverage would have large change in the operating income of relatively small change in sale. This is what we were describing. Small change in sale will have larger impact on earning before tax, right? If I do 11,000, 10% change, then it may have 17% change, right? So far so good on operating leverage. Any doubt here before I jump onto the financial leverage?
So when we are doing practice, then we would be able to understand it better.
Yeah, yeah. That's the reason I'm simultaneously doing it. We have like one illustration as well after this. So we'll do this small illustration as well. Hmm. So second is financial leverage. Financial leverage, like we were discussing earlier, that has more related to financial expenses, financial cost, which is your interest cost or your cost of preference share, right? Which is fixed in nature. It refers to the extent to which debt and preferred stock, fixed income security, are used in the capital structure. How many debenture, how many debt, how many loans you have taken, and how much preference share you have issued, for which the dividend is fixed and cumulative, right? The larger the percentage of debt and the preferred stock that is used for financing, the greater the risk of the company will not earn enough to cover the fixed interest and preferred dividend payment, right? The more leverage, the greater risk and the higher cost of capital. So the degree of financial leverage, how do you calculate? Is equal to percentage change in net income divided by percentage change in net operating income. That means percentage change in profit before tax divided by percentage change in EBITDA. Or I would say, right? So, or otherwise EBITDA minus interest minus preference dividend gross of taxes. Change in income, that is profit before tax, divided by change in net operating income, right? So here, if you see profit before tax is $100,000, right? And EBITDA is 150. That means this 50,000 is impacting difference between EBITDA and profit before tax, right? So what it says, the degree of financial leverage. How do you calculate degree of financial leverage? Change in income divided by change in EBITDA, right? So in these two example, change in, what is the change in income? So if I hide this just for the benefit, so this is year 1, this is year 2, and the change is 60%, 60,000, and this is 10,000, and this has resulting to change of $50,000. So if I just remove this for financial leverage, what it is saying, percentage change in income. So what is the percentage change in income? 50,000 divided by 100,000. That is your percentage change in income. Divide by percentage change in EBITDA. What is the percentage change in EBITDA? 40%. Right? So this divided by this. So it shows degree of operating financial leverage, degree of financial leverage. That means EBITDA minus interest minus preference dividend if there is any. So that may give you profit before tax. Right? So we'll be doing an example on financial leverage also, or maybe so first let's quickly understand what is total leverage. Total leverage or a combined leverage is the operating leverage plus financial leverage, or operating leverage multiply by financial leverage will give you the total leverage. Total leverage, sometimes we call it total leverage, sometimes we call it degree of combined leverage, or sometimes we call it combined leverage. So very simple formula, degree of operating leverage multiplied by degree of financial leverage. This will give you total leverage or combined leverage, right? Otherwise, how can you calculate this? Change in net income divided by change in sales. Change in income, I would say, that is your PBT, divided by change in sales. So the total leverage is change in sale, you have $100,000, and change in profit before tax is around $50,000. So here the total leverage is change in sales divided by change in profit before tax is around 200%. Right? We'll do the calculation, don't worry. So this is what it means, change in income divided by change in sale. How sensitive your income is on account of change in sale. If sale increasing, is it increasing more than the sales? If sale decreasing, is it increasing? Is it decreasing more than the sales? Right? That is called the leverage, or you can say the delta. If an entity used both high degree of operating and financial leverage, only small change in the sales will result into the large fluctuation in earning per share, right? If the degree of financial leverage and operating leverage is high, so small change in sale may have bigger impact on earnings, or you can say earning per share, right? The ratio can be used to predict the effect of a change in sales to the income and ultimately to the earnings available to the common stockholder, right? The ratio is determined by the relationship between operating and financial leverage, right? How do you determine the ratio? Operating and financial leverage you need to calculate individually, then you are multiplying both of them. So with the operating leverage you will be able to understand the impact of operation. With the financial leverage you will be able to understand the impact of financing cost, right? For example, if the risk is lower by reducing the degree of operating leverage, then the firm would be better positioned to increase to use the debt. Thus, increasing the financial leverage will help. So, this is also when you are doing like decision making for an organization. So, the ratio analysis and the leverage analysis will help you in better structuring the capital of the organization. A firm can change the degree of operating leverage by changing the proportionate to the fixed cost to variable cost, right? So this is normally a graph which is reflecting your cost, income, and in between this point, interject point, is called break even point, and above the break even point, whatever is the gap you are seeing is the operating profit, right? Let's try to solve an example. So here you have sales of $100,000. You have variable cost, or you can say cost of goods sold. Let's assume $60,000, and you have fixed operating cost $20,000. So your EBITDA is $20,000. Yes, no,
Yes, sir.
right? And you have fixed interest cost 15,000. So your earning before tax is 5,000, and you have 40% tax rate, $2,000. So your net income is 3,000, right? This is given previous year, right? And then you have change in current year. Your sale has increased by 10%. So your earning before interest and tax has been increased by 20%. So your finance cost is constant. What will be the impact on net income? Right? If you see, the resulting change is on account of change in these percentage. Right? What is the question saying? There is 10% increase in the sale. What is the impact of the same in EBITDA as well as into the net income? Right? So there are two leverages. One is operating leverage, second is financial leverage, right? How do you calculate operating leverage? Contribution margin divided by contribution margin minus fixed cost, right? So your operating leverage is in the previous year. What is your contribution margin? 100,000 minus $60,000, that is your contribution margin,
Yes, sir.
right? That is $40,000 divided by the contribution margin minus fixed cost, 40,000 minus 20,000, right? So this is 2. Are you
Yes,
guys
sir.
with me?
Yes, sir. Clear.
Right? On the other hand, if you see the increase, if I do calculate here other formula, which is percentage change in EBIT divided by percentage change in sales, right? So what is the percentage change in EBIT? 20%,
Yes, sir.
right? So 20% divided by what is the percentage in sales? 10%. This will also
Yes,
give
sir.
you the same result. So both the option will give you same result. Make sense?
Yes, sir.
right? Here you can say or, right? Now another thing is financial leverage. What is the formula for financial leverage which we have studied? Change in income, profit before tax, divided by change in EBIT, or EBIT minus interest minus preference dividend, right? So here if you see EBIT divided by EBIT minus interest expense. So earning before interest and tax you have calculated already 20,000, right? And your fixed cost is 15,000, and your EBIT minus interest expense 15,000 is $5,000. So your financial leverage is 4 times, right?
Yes,
Yes or no?
yes, sir, clear.
Or the
Combined leverage.
no, yeah, I will come to that, but I'm just adding this formula as well here. Percentage change in income divided by percentage change in EBIT. So what is the percentage change in income we have seen here? 9,000 is the EBIT compared to 5,000, right? So the change is 80%. 4,000 divided by 5,000. Make sense? Or shall I do the math here? So your current year earning before tax is 9,000. Previous year it was 5,000. So what is the change? 9,000 minus 5,000, right? So what is the percentage change? 4,000 divided by 5,000, 80%. Is it good, everyone?
Sir, एक बार फिर से बताना है.
So here if you see your next year earning with profit before tax, or you can say earning before tax is $9,000, right? And
Yes,
your
sir.
previous year was $5,000. So what is the change? $4,000, right? What is the change? $4,000.
Yes, sir.
Agreed? And what is the percentage change? 4,000 divided by 5,000, 80%,
Yes, sir.
right? So same thing we'll do here. So what is the percentage change in PBT? 80% divided by what is the change in earning before interest and tax? 20%, right?
Yes, sir.
So how sensitive it is? 4 times,
4 times.
right? So both the formula, it again depend on question, right? What all
Yes, sir.
information is provided to you in question. Accordingly, you can apply the respective formula. Make sense?
Yes, sir. Clear.
And the last one is combined leverage, right? Combined leverage is operating leverage multiplied by finance leverage,
Financial. Yes.
or I would say we can do this also, or change in income, that is profit before tax, divided by change in sale. So here we have calculated 2 into 4, 8 times,
Yes,
right?
sir.
So otherwise if you see what is the change in income, 80%,
Yes, sir.
and what is the change in sale, 10%,
10. 8. That is also it.
right? So this is 80% divided by 10% will give you 8 times, right? So in the both the scenario answer remain 8 times, right? Clear?
Yes, sir. Clear.
So one thing is understanding the formula. Second important thing which as a CPA is very much required is application of these formulas. right? Most of the time student mug up the formula, but they get confused when it comes to the application of the formula. So if you remember, when we have started this BAR class, I told you almost 30 to 35% of your exam will comes for the application of the concept which you are studying, right? Hence the application is very important. So let's do few practice question to understand application of the operating leverage and financial leverage. So first question we have, so the question number one, capital structure of Simon and Company is as follows. Financial leverage of the company would increase as a result of what? What is the call of the question? Financial leverage of the company would increase as a result of what? So which one will increase the financial leverage? That is something you need to keep in mind. Always make sure you understand the question properly, and more importantly, what is the call of the question, right? Most of the time students get confused in exam. They understand the question but they miss out the call of the question. So in the question there may be multiple information provided to you. So you need to identify which information is relevant to provide the answer. So here call of the question is which statement is correct in the context of financial leverage of a company. Like company do have debenture, company have preferred equity, and company have common stock, right? So what is your common stock? 39 million. And what is your preferred equity, preferred stock? 1 million. That means equity you have $4 million. And how much is the debenture you have? So sorry,
And
total capital, equity plus preferred stock, you have $40 million, and the debentures you have $10 million, right? What is the debt to equity ratio here? 1/4,
yes, sir.
right? So look at all the four options and understand, identify which option is correct. Using common stock and using the proceeds to retired preferred stock, will that increase your financial leverage? That means if you are issuing more equity or preferred stock, will that increase your financial leverage? Hmm? First
No,
option
sir.
is using the
Incorrect.
common stock and using the proceeds to retire preferred stock, will that increase your financial leverage? What is financial leverage? Finance cost,
On the
right?
account of financial cost.
Finance cost comes from interest, right? Interest will come from debenture, or you can say bonds or loans, right?
Yes, sir.
So will that be impacting your financial
No.
leverage?
Yeah.
Yes or no?
Yes, sir.
No.
The first
Because,
one will not impact.
yeah, first one will not impact,
Will not
right?
impact
Because
because
that's
it's not
equity and
included. Yeah.
yeah, absolutely.
Interest is not included, or
Yes.
the debt is not included in this.
Second is
Yeah.
issuing common stock and using the proceed to retire the debenture. That means you are issuing more common stock, you are issuing equity, and whatever the money you are getting out of it, from that money you are releasing debenture. That means your debenture is reducing. So if your debenture is reducing, your interest cost will go down, right? Will it
Yes.
increase your financial leverage or decrease your financial leverage? It will decrease, right?
Yes.
What is the call of the question? Financial leverage company would increase. Which one increase? So second option is also incorrect.
सर एक बार ये सेकंड वाला फिर से बताना.
Second option says you are issuing common stock. That means you are giving equity, right? And by giving equity, you are receiving some cash,
Yes, sir.
and that cash you are using to repay the loan, repay the debenture. If you are repaying
Okay.
the debenture, your interest cost will go down.
Yes,
If
sir.
your interest cost will go down, the financial leverage increasing or decreasing? It will decrease your financial leverage, right?
Yes, sir.
So it is incorrect because call of
Okay.
the question is increase the financial leverage, right? Financial leverage company would increase as a result of what? Make sense,
Yes,
Kashish?
sir. Got it. Got it.
Third option is financing the future investment with higher percentage of bond, right? That means you are taking bond and bond have interest cost that will increase your financial leverage, right? So this seems to be a correct answer, third option, right? Let's look at fourth option, financing its future investment with higher percentage of equity fund. Equity fund will not impact your financial leverage. Equity fund rather decrease your financial leverage, I would say. Make sense?
Got it, sir.
So which option is correct?
Third one.
Right, everyone?
Sir,
Matthew,
even if it
Yes,
Kashish?
is
yes.
even if
Mhm.
it is high percentage of debentures as well as,
Yeah,
loans
if
as
it is
well,
higher
then
percentage, it means more interest.
hmm,
So if it is more interest, it will be more financial leverage,
yes, sir. Got it.
right? Second question, which among us the four option is one method by which company achieve its optimal capital structure of 48% debt if its current portion of debt is 40%? That means currently their debt to equity ratio is 40:60. So they have 40% debt and 60% equity. Right? Out of this four option, how the debt to equity ratio will increase to 48%? That means 48% debt. That means we need to choose the option which is increasing debt, right? First option is introducing a new product using existing fund. Will it impact anything?
Nice, sir.
No impact, so incorrect answer. Second is outsource the internal audit function. Will it impact on leverage?
Nice, sir.
No. Third is acquire new long-term asset using cash. So you have purchased any property, plant and equipment and you have given the cash. Will that impact financial leverage? Will
Yes,
that
sir.
impact anything? Yes or
सर
no?
होना तो चाहिए. Yes, sir.
Why? You already have cash. You are not issuing any loan. You are not issuing any security. You are not financing it. Right? If you have taken loan, then it would have been. But what they are saying, it's cash. You already have cash
Okay, okay.
and you are purchasing asset. So that may not impact anything, right? The last one is
Okay.
acquiring treasury stock. What does it mean? What is treasury stock? What is treasury stock?
Government bond.
Say that again.
Government bonds.
No, no.
But like
Yeah, Kashish.
giving loans.
No, boy. We have discussed many a time. Treasury stock is buyback of share.
Yes, sir. Okay, okay. Yes, sir.
Right? Have we discussed this?
Yes, sir.
How many times? More than
Multiple
100
times.
times. Right? So, Matthew, just for your information, in US, in India we call the term buyback, but in US we call it treasury stock. That means stock which company purchase back, right? So when you are purchasing the equity, so equity ratio will reduce, right? Equity will reduce, so
Yes.
automatically in your overall capital, proportionate of debt will increase, right? Make sense?
Yeah. Yes.
So that is the correct answer is fourth.
Okay.
Make sense?
Yeah.
Right? So, we don't have time to start new topic. So maybe we can close the class over here. Tomorrow we'll be covering remaining two topics. And I'll send you the notes, request you to go through these notes before
The
coming to the
last
next class.
last class the notes are pending.
Oh, it's missing. Okay, I'll send you both right now. Okay. So
Okay.
tomorrow we'll be covering this capital structure. This is very important, and you may see a full-fledged simulation on the capital structure also, right? And the financial structure is just an extension of capital structure, very small one. But this one is important topic. In this, most of the time I've seen a full-fledged simulation will be coming in your exam. So this one is slightly important. Please do pay attention to in tomorrow class. Right?
So, sir,
Yes, yes.
yeah, where we can get the recording links and all.